Hello, everyone. This recording is part 2 for Chapter 6, Revenue Recognition. This is the appendix. This part of the material, it came from the appendix portion of it. In this one, we have learned how to record the revenues using the 5 steps, and then in this one, what we're doing is we're learning about 3 different methods that can be used recording the revenue. For what we learned in the chapter previously was, for the most part, the company recognized the revenue at a point of time, because when the control over the goods and services are passes and the performance obligation is satisfied, and that's what we record a revenue. We could be recording a revenue as a on credit or a sales, on credit or a cash. So that's what we learned up to now. But now the accounting for long-term contract. So if the contract, if we wanted to learn the accounting for long-term contract, poses some challenges because they have unique features. Now, the first feature they have is the contract are for longer term. If it's for shorter term, we can recognize the revenue what we at a point of time. In this case, we cannot record the revenue at a point of time. In this case, the projects, the contracts are for a longer term. That's the first thing. Second thing is the other unique feature is that this long-term contract grants the ability to send progress via billing. This right to bill helps the company finance the project. If the company is making a bridge, what they need financing. If you're allowed to bill it before the project is completed, then it helps the company with the billing. The example of long-term contracts are construction type contracts, such as building a bridge, a development of military and a commercial aircraft, weapon delivery systems. These are some of the contracts that are long-term. And for those contracts, what we're going to use is we could use percentage of completion method, completed method, or a zero profit method. So those are the 3 that we're going to be doing. But the first one that we wanted to learn is the percentage completion. Now, if one of the criteria is met, say if at least one of these criteria is met and the company is able to estimate the progress towards completion, then they are allowed to use a percentage of completion method. The customer receives and consumes the benefit as the seller performs. Only one of the criteria has to be met. The customer controls all the assets. The company does not have any alternative use of an asset, has the right to payment for the performance. Only one of the criteria is met. Normally, when you have a long-term contracts, one of the criteria is met. Normally, the third one is the one that is normally met when you have any long-term contract. And if the company the company can reasonably estimate its progress towards satisfaction of the performance obligation, and then the company recognize the revenue, gross profit for each period based on the progress of the construction, referred to as a percentage of completion. So what we're going to do is we need to calculate the progress. How we're going to calculate the progress of the project is by calculating the percentage. So we know what percent is the project is completed, and from that point we are allowed to record the revenue, and we're allowed to record the gross profit. The revenue and gross profit, when they say that, you're allowed to record the revenue and the expenses, only portion of the project that is completed, and that will give you a gross profit. So we're going to do it. What we're going to do is we're going to use the how do we calculate the percentage. In this case, there's a formula to calculate the percentage of completion. Formula for percentage of completion, which is cost incurred to date. This is cost incurred to date divided by the total cost. The total estimate cost will give you every year. If the project is for 3 years, you have to do it for every year till the project is completed. So you need to find out the percentage of the project that is complete. From there, what you can do is use that percentage you calculated, you multiply by the estimated total revenue, and then that will give you the revenue you have to recognize to date at that point. So in this case, your total revenue, how you're going to know the total revenue? If your project is the transaction price is your total revenue at that time. So transaction price will be the total revenue. From there, once you calculate the revenue to be recognized to date, then you can minus what you recognize previously, and that will give you the current year's revenue. So the revenue to be recognized to date, that's what you calculated in step 2. And from that step 2, what you wanted to do is you have to record the revenue for the current year. And how you're going to do that? By taking what you recognized before and minusing from the total revenue at that point, and that'll give you for the current year. But it makes more sense if you do it in if I show you from the question. So in this case, the question says that the Hard Hat Construction Company has a non-cancelable contract to construct 4.5 million bridge, and the total estimated cost is that. So the transaction price is 4.5. That's the contract price, and then the cost will be 4 million. Of course, the company Hard Hat is a construction company. They're going to make money out of it. At this point, they're going to make $500,000, but we don't know how to record that $500,000 using we wanted to do how to record that using the percentage of completion method, and that's the first one. So this is given to you in the question: cost to date, estimated cost to complete, and that one is called that total estimated cost to complete, and we are allowed to bill it as progress billing, and then we have a cash collector. We can collect the money that we bill to the customer. In this case, first method is the first thing you have to do is to calculate the percentage complete at the end of each year. So percentage complete, you need to calculate it at the end of the year. So the contract price, if you set it up this way, it makes your life a little bit easier. If you have a contract price is given to us. That's the price that is 4.5 million. So it doesn't change. The contract price does not change because that's what we set at the time you sign the contract. The second thing you needed is cost to date. Cost to date will come from the question or from the company. They will know how much cost they incurred up to that point, how much they incurred at that point. So if it's to date, means that it's not for that current year. To date is when you needed to account for that in 2021. This is the first year you're starting the project, so the first year your cost to date is only $1 million estimated at that point. Estimated cost to complete is 3 million. Then what you need is the estimated total cost. What you're going to do is how you're going to calculate that is by adding both of them together. That will be the 4 million. And the first thing you needed before you get to the gross profit, what you needed to do is what percent of the project is complete. So how you're going to do that? By taking this is the formula that they showed you I showed you in the second slide. What you have to do is the cost to date divided by the total cost. So cost to date divided by the total cost, and then in this case $1 million divided by 4 million, and that gives you 25%. So the project is completed 25%. If it's completed 25, the progress is 25%. We're allowed to record the revenue and cost only the 25% for the first year, and because we only completed the 25%. If you go to the next year number 2, what you're going to do is how you're going to calculate the percentage complete at the end of the second year. What you're going to do is you're going to take cost to date. The formula is cost to date divided by the cost to complete. That will be your percentage. In this case, it will be 72%. And when you go to the third year, if the project is for 3 years, the last year you're going to complete the project fully. If you're going to complete the project fully, what you're going to do is you're going to take the cost to date divided by the total cost, and that will be completed 100%. The first step is to complete the percentage complete using the percentage of completion method. In this case, we calculated it's a 25% first year, 72% second year, and the third year we're going to complete the project for the full year. So that's how you complete the how do you calculate the percentage of the project. Then next step you have to do is you have to journalize it. When you journalize it, the PowerPoint does a good job, but it doesn't do a job that to get to the question. So what we're going to do is the first question will be as they occur, construction costs are accumulated, and what we do is we debit the contract as a liability account, and we credit the accounts payable account. So we are able to do the entries from this table. So if I were to do that for the first in year 2020, what we have is we have to debit. What are we going to debit? We are going to debit the contract asset / liability, and that is 1 million, and that's the first year. That's the cost. That's the 1 million is the cost in this case. And then credit will be your accounts payable, and you can also call a material, but in this case you could have a material, you could have an inventory, you could have a cost. So in this case that will be a credit of a 1 million. So that's for the first year. So we're going to do the first year, and then we're going to do the second year, and then we're going to do the third year. But in this case, we are only asked to do for the first year. So when you go forward, the next part of the entry, the second entry, as they occur, billings are credited. So billings are credited to which account? Contract as a liability account, and debit the receivables. So now, since you complete the construction company complete the 25% of the project, they're allowed to bill. So how much they're billing? So then debit will be your contract asset / liability account, and credit will be, your debit will be accounts receivable. You're billing it, in this case I just got carried away. It's a credit to the contract asset account and debit to the accounts receivable account. So debit will be accounts receivable, and credit will be your contract, I should have a more room, contract asset / liability. How you going to get the billing? It will be given to you in the question, or we know how much we're billing. In this case, we're billing 900,000 and we're collecting 750. So my billing will be, debit will be my accounts receivable, which will be 900,000, and credit will be your contract asset / liability. So now those are the two entry, and the third entry is at the end of the period. So 1 year has gone by. We know we completed a project. How much of the project is completed? 25,000 of the project is completed. So what we allowed to do is that they didn't do the entry for they missed one entry here. We are going to collect we are going to collect it, but they didn't talk about the collection of it. But we're going to show you the collection entry, and I'm going to show you that is normally the third entry is that. So in this case, that will be third entry, this will be fourth, and this will be a fifth entry. So in this case, the third entry will be for the collection. So if you're going to bill the customer, now you have, they're going to pay you. So how you do the collection, you're going to debit your cash, and credit will be your accounts receivable. In our question, they told us it is 750,000. That's how your collection is going to be collected. So in this question, they told us cash collected during the year is 750,000. Normally, that is my third entry. So third entry will be the collection, debit the cash, and credit the accounts receivable. Now we're going to go to the fourth part of the question. The fourth part of the question is telling us at the end of the period. Now you finished year one, the cost of the construction for the period is taken out of the contract account and debited to the construction expense. But we can only do, how much we could do? We can only do 25% of it. So if we are only doing 25% of it, we actually not 25%, the revenue is only recognized 25% of it. Now what we are doing is we are, whatever we the the construction for that period is taken out of the contract asset account and debited to the construction expense. My entry will be, debit will be your construction expense. So then in this case, we're doing it for 2020, and credit will be your contract asset / liability account. So what this account is only there for the part of recognizing the assets and the liability. So that will be taken out of the contract asset and a liability account. How much is going to be now in this case, we have this is our first year, our cost is $1 million. So what we are going to do is we're going to record the construction expense for the $1 million. So if we record the expenses, now we have to record, we're allowed to record the revenue, but revenue will only be allowed to record 25% of the revenue up to this point, because we only can recognize the project that is completed. What percent is completed? 25% of is completed. And how you're going to recognize it? You're going to take the contract price. In this case, it was 4.5 million, multiply by 25%, and whatever that profit, whatever that is, that's what we're going to recognize. In this case, it'll be 1,125,000. And what we're going to do is, if you're recording a revenue, if you look at it, you have it says that it's taken out of the contract asset account, and it is taken out of the contract asset liability account and credited to the revenue accounts. So what we're going to do is we're going to debit, and what we are debiting is we're debiting the contract asset account, and that will be my debit, and it will be contract asset / liability account. And how much is going to be? It will be 1.125000, and then we're going to be crediting what we are going to be crediting. It will be revenue from long-term contract. In this case, I'm just putting the number. The transaction price is 4.5 million, and we multiply by the 25%, because the only 25% of the project is completed. So we only going to do 25% of the we can only recognize the 25% of the project. Now those are the only 5 entries for each year. So entry 1, 2, 3, 4, and 5. So what you could do is, now we could do the entries for each year. So we could do it for the each year. So I'm going to do it for this is my third, and this is my 5th entry, this is my 4th entry, this is my 3rd entry, and this is my 1st entry. So now what we're going to do is we are going to go to my year 2021. I'm going to do to my year 2, because it's good to do all the entries, and then we'll show you how to recognize the profit for each year. So now if you look at it, so the first entry was for the construction cost. They're saying that the debit and credit will be exactly the same. The only difference will be that we have to recognize, the only difference is going to be that we have to, the only difference will be we needed to change the amount. So the first thing is going to be, I'm going to just change the ink of it so we know that. So what you're going to debit, is your, let's see if I can create a bigger room so that I'm writing it nicely. So first entry will be your contract asset / your liability account, and then the credit will be your accounts payable. In this case, the accounts payable. So what we have to do is we needed to go to my year 2. We know that this is cost to date, but if we are doing this entry, we're doing it for that year. So what is the cost? Now this is to date. So what we needed to do is, if it's to date, we needed to take what is for that current year. So in this case, to date is 2,916,000. That's the to date cost. What we're going to do is take out what we recorded already in the first year. We recorded 1 million for the first year. So now what we can only record is the difference between the both, and that will be we're going to recognize in the second year. So that's what we're going to do. When we're going forward, they're saying as they occur, the billing, now we have to bill it. So the billing will be given to us in the question. When you bill it, you debit the accounts receivable and credit your contract asset/liability account, and then how much that is going to be. It will be given to us every year. Now in this question they told us during that year. If during that year, it means it is for that year. So in this case it will be the question is 2.4 million. So that's my billing is 2.4 million. And then what we needed to do is we needed to do the third entry, and the third entry I'm going to do at the bottom to do the collection. In this case I am going to do the collection. When you're collecting it, what we're going to do is debit your cash and credit will be your accounts receivable. In this case they told us what that is going to be. It is 1,750,000. So let's do that. 1,750,000. So that's the accounts receivable that we have. Now we're going to go to the fourth entry, and the fourth entry is to record the construction expense. Construction expense during the year. So how are we going to get the construction expense? You're going to debit the construction expense, and credit will be your contract asset/liability. So what you could do is there's two ways of calculating it. Now if you whatever it cost us, in other words, what we did is we bought the material. What we did is we bought the material, that's the cost. So then that's what we could record for the year. So that will be 1.9 1,916,000, 1,916,000. It is, we can only record for that current year, because in this case we are doing journal entry for the current year, so we only allowed to record it for the current year. Then the next part of the revenue is to record the revenue part. When you're recording the revenue, what you're going to debit? You're going to debit the contract asset/liability, and credit will be your revenue from long-term assets, revenue from long-term contract. Now when you're doing it, this is a little bit different from the previous year. So now we needed to do is, we know that the revenue that we are going to recognize is 75%. So because not 75%, what percent of the project was completed? In this case, the project that was completed was 72%. So we are going to record the revenue 72%, but we wanted to know that's the total project that is completed. So what we needed to do is we needed to know how much was recognized before. We can only do it for the current year. So in this case, this was the total revenue that should be recognized up to this point. In this case, it comes out to be 3.2 million and 3,240,000, but we already recognized the 1.1 million for the previous year. If you recognize the previous year, so what we needed to do we need to do the entry for the difference between the both. In this case, it will be 2,115,000, 2,115,000. So that will be equal to 2,115,000. So in this case, what happens is that we know the project is completed 72%, but we already recognize the revenue 72%. So whatever we already recognize, we needed to take it out what we already recognize. So that my current year's revenue will be this is my total revenue. This was my total revenue. From there, this is what we are allowed to recognize up to this point, and we already recognize the 1,125,000. So then and then going forward, now we are going to go to the year 2020. Now the project is completed 100%. If the project is completed 100%, so now what we're going to do is we're going to go to your last year. So now what we're going to do is that we're going to do, our first entry will be your contract asset/liability, and credit will be your accounts payable. How you're going to do the entry? Now we know that to date cost is 4,450,000. From there, what we did is we already recorded some of the revenue and some of the cost. We recorded the first year, we recorded the there's two way of calculating it. You could do it in this way, or I'll show you another way. The first year we recorded the cost of 1 million. The second year we recorded the cost of 1.96000. So now whatever is the leftover, now we are allowed to do it this year. So in this case, I'm just doing it as we go because I don't have an answer. In this case, I come up with 1134000, 1134000. So this is the this is what our cost is going to be. Then the second entry is we needed to bill it. So now we have a debit accounts receivable, and credit will be your contract asset / liability. If that's the case, we needed to go up, and it is 1.2 million. So it is 1.2 million. And this is 1.2 million. And then what we did is we also collected at the same time. We collected 2 million. So that will be my third entry. My third entry is for the collection. When you collect it, debit the cash, and credit your accounts payable. In this case, it was 2 million was my my collection, and that was 2 million. And then what we are going to do is we're going to do our fourth entry, and then we are going to do our fourth and our fifth entry. Our fourth entry is we're going to do a expense. When you're doing an expense, so whatever we paid for the inventory or for the construction cost, what we are doing it, we are going to be recording that. So you're going to debit the construction expense, and then credit will be your contract asset / liability, and that will be what you're going to do is, now we know that it will be your 1134000, 1134. So whatever was our expense, we're allowed to record that expense. And then what we have to do is now we have to record the revenue. Of course, we're doing the matching principle here, so we have to record the because if the expense happened, we needed to record the revenue. How do we record the revenue? In this case, debit will be your contract asset / liability, and credit will be your revenue from long-term contract. How you going to do that? We started off with our total transaction price is 4.5 million. We recorded some of the revenue for the first year, that we recorded 1,125,000. Then we also recorded the second year. The second year we recorded the revenue of 2,115,000. So now whatever is the leftover, we're going to be recording it here. In this case, it is 126,000, 126,000. So that's the revenue we're recording. Next part of the question is normally how much of the next part of the question is saying how much of the gross profit should be recognized per year. So in this case, it makes a little bit easy. Now, if you go through each of the questions, so in this case, what goes onto my income statement? My income statement, what goes it? What goes it into in my income statement? Only the revenue and the expenses. So if you were to do it the first year, so in this case, if you do it for each year, if you were to get the numbers, I'm going to see if I can take a different number. I'm in different ink. So what you're going to do in the first year, this was our first year, we have a construction expense. My expense was in the first year. If you look at it, our expenses was in the this is to date, and this is what is recognized in the current year. So this was my expense. What was my revenue? My revenue was, your revenue was here 1125000, and that is your revenue. So in this case, you are taking the revenue and you're taking the expenses, revenue minus expenses, and that is your profit for the current year. So in the first year, your profit is that you're going to recognize is 125,000. If you go to my second year, you will look at it. We have an expense of 1,916,000. So what you're going to do is, that is your expense, and we have a revenue revenue is given to us, and that is my revenue. So in other words, it makes it a little bit easy when if you do the journal entries first to show what goes on your to your income statement, and then you're going to do the same thing what we did in the third year. Your expense was 1,134,000, and that's what the expense is. And what was my revenue? My revenue was 1,260,000, and that's what for that year. So they're asking you for the current year. So in this case, these are your revenue and expenses. All you're going to do is, if you were to do it under you could also do a T accounts. If I do an expense and I could do a revenue for each year to make your life easier. So what you're going to do is, you have a expense in this case for if you're doing it for this year. So in this case, each year you're going to have a revenue and expense. In this case, the expenses was the expenses was 19616, and then the revenue was 2115, and difference between those two will be a gross profit. If I go to my third year, I have an expenses, construction expense, and we have a revenue from the construction from the long-term project. My expenses here was 1134, and my revenue was 1260123. So that was my revenue in this point. And then when you go to the first year, I'm just going to do the 2020. We have expenses and we have a revenue. In this case, the first year, the expenses was 1 million, and the revenue was your 1.125. That's the revenue. So it's just, if you do a T accounts, it does the same thing as what they're doing here too. So that's how you do the journal entries. This is how you calculate the gross profit. And then once you calculate the gross profit, this is how it's going to look like on your income statement of financial position, and it's going to look out on your balance sheet. In this case, the other account, what goes onto your balance sheet, your accounts receivable goes there, and your contract asset and a liability account there. So in other words, if you do a T account for your construction asset account, it makes your life easier to post the numbers. So that's what goes on to the each one. For each year, they only showed you for the 2020, and we can do it for each year. So that's just the first method of recording your if the company is for the long term. If the company is using a percentage of completion method, that's the method that's the journal entry you do, and that's what you're going to be asked to complete the percentage, and then you'll be asked to do the journal entry. But you're only going to be asking for 1 year, but the percentage you needed to be shown for each year. So each year you do the percentage, from there you do your journal entry. So the journal entries are exactly same. The only thing changes is the only thing that changes is the amount that you record for each account. It changes. Now that's the first method of for the long-term contract, is a percentage of method. The second method that is used is the company can also use a completed contract method. Under ASP, if a company is uncertain about the outcome of the contract or the performance consistence of a single act, they would use the completed contract method. So they will be allowed to use completed contract method. So revenue and expenses and gross profit is what is the difference between the one we just did, the one we're using now? Completed contract. So what happens is revenue and expenses and gross profit. Everything else you're allowed to journalize it. The only thing is revenue expenses are not allowed to. You're not allowed to record a revenue expenses until the project is complete. In this case, when the project is complete, that's when you recognize the revenue and expenses. So in this case, your first entry will be same, your second entry will be same, your third entry will be the same for the first year. So if it was the same question and you're using a completed contract method, how does it change? So the only thing changes is you are not going to have a revenue entry, and you're not going to have an expense and revenue. These two entries are not going to be there. So if you were to do the first, all the other entries are exactly the same. So all the entries are going to be exactly the same. So what we're going to do is I'm just going to take you here and then show you what the entries are going to be. So your first entry, if we said that it is going to be the same, second entry is going to be the same, third entry, you're not going to record the third entry because now you're not using a percentage of completion. What method you're using? You're only going to use the I'm just going to erase it to make my life easier because it just makes it really complicated when you have a lot of numbers on the screen. So now what we're going to do is we're going to show you what I'm going to show you. We're going to show you how to journalize if the company was using a completed contract method. Our first, now we're going to do is, what we're going to do is we are going to show you. I'm going to see if I can use the thick ink. So in this one, what we are doing is we are using a completed contract method. So in this case, we're going to be completed contract method. So what we're going to do is for the year 2020, for the year 2021, and for the year 2022. So first entry is going to be for the construction cost. Of course, the entry is exactly the same. What you're going to do is you're going to debit your contract asset / liability, and credit will be your accounts payable. In this case, it is going to be $1 million. So what we're going to do is the entry will be exactly the same what we did under the percentage of completion method. The second entry is we needed to bill it. So if you bill it, you're going to debit the accounts receivable and credit your contract asset / liability. What is our billing? Our billing for the first year was I believe it was 900,000. So let's bill it. So that's your 900,000 liability. That is your 900,000. The third entry is for the collection. When you're collecting it, you debit the cash and credit your accounts receivable. We're collecting 750,000. If it's a completed contract method, we do not record any construction expense till the project is completed. If we don't record the expense, we do not allow to record the revenue. So your fourth entry, there will be no entry, no entry for the expense. And the fifth one, we had it revenue, no revenue entry at this point. At this point, no revenue entry and no expense entry. But now when you go to the next one, you still going to have it. So now you're going to debit. I'm just going to put it in the amount. You're going to debit the contract as a liability account, and you're going to credit accounts payable. But the amount will be, you're going to be calculating exactly the same. The cost is the cost to date is 2,916,000. From that, we already recognize $1 million. So then the only thing we are going to recognize is 1,916,000 and 1,916,000. So in this case, debit will be your construction asset account and credit will be your accounts payable account. Then you're going to do the same thing. Debit will be accounts receivable and credit will be your contract asset / liability account. How much is that? They told us in this question is 2,400,000, and this is 2,400,000. Go to your next one. How much we collected? Debit the cash, credit the accounts receivable. We collected 1,750,000, and that will be the entry. Again, no entry here for the expense and no entry for the revenue because revenue will be recognized at the end of the project. So at the end of the project. So now we go to our next one. You're going to go do the same entry. So the cost to date was 4,450,000. From that, we recognize 1 million in the first year, and then we recognize 1,916 for the second year. So what we needed to recognize 1,134,000. So what you're going to do is you're going to debit your contract asset / liability account. Credit will be your accounts payable. In this case, 1,134, 1134000. And then what we are going to do is, then next one is your accounts receivable, and we have a contract asset slash liability account. What are we doing it? We billed at 1.2 million, so we're going to billing it, so 1.2 million. The second one is we're going to do is you debit your cash, credit your accounts receivable. In this case is 2 million, and then you have accounts receivable is your 2 million. Now this is my third year. Now the project is 100% complete. Now we are allowed to record the revenue and expense here. So we are allowed to record the revenue and expense. So what we are going to do is revenue and expense entry here. What we are going to do is we're going to be combining that entry, and I'm going to show you how to write that entry. So we're going to be combining the entry. This entry will be done at the end of the year. We are allowed to record the revenue. Revenue will be your transaction price. It is revenue from long-term contract, and that is your contract price. In this case it is 4.500,000. You have to debit is, what are you debiting? You are debiting your contract asset slash liability account, and then debit will be your construction expense, and that it is to date. Construction and expense is to date, so we have to do it to date. Is what is the construction as expense for to date is it is your if you look at it to date is, if you were to do that, your cost was 4.5 million. So in this case, the first year the cost was 1 million. The second cost was 1,916,000. The third year the cost was 1134. So altogether we have a 4.5 million. That is your construction expense, and the difference between those two is your contract asset and liability. That is your 415,000. So that's what the revenue is recognized at the end of the year. So that's what that it is recognized at the end of the year. So that's a difference between the completed contract and the percentage of completion. All the entries are same except your entry number 4 and the entry number 5. Now we have another method that the company is some company, anybody can do it, company is allowed to do it, is called the zero profit method. So when that happens, when it says the zero profit method, is that you are not allowed to record, you are allowed to record the revenue and expenses for the each year, but what we are doing is, it's called a zero profit, but you're not allowed to show the profit till the end of the year. So all the entries are exactly the same we did, but the only difference is that now the third, the fourth and the fifth entry is different. How you're going to record the fourth and the fifth entry is by, now this is the last part that we're going to show you, is the zero profit method. So like I said before, zero profit method, revenue and expenses are not they're recorded, but they're recorded at the same amount. So whatever our expenses, we have to record the same revenue and the same year. So we cannot create any profit. So whatever our expense was, that's what we have to record. So if you were to do the first entry, our first entry will be for the 2020, it will be exactly the same, but we're going to just do them and then show you how they are going to be same. In this case it is 2021. So the first entry is you have our first entry was what we did is we paid for the material. Your debit will be your contract asset slash liability, and credit will be your accounts payable or material. In this case, accounts payable. In this case, the cost of our material was $1 million. So that's what is going to be the 1 million. The second entry, again, we are going to bill them. If you bill them, debit the accounts receivable and credit your contract asset slash liability. In that case, we bill them 900,000. So that will be our entry, debit and a credit. And the third entry is for the collection. When you collect it, debit the cash, credit accounts receivable. And I believe it was, now I remember the numbers, it was 750,000. Our fourth entry was for the expenses, and the fifth entry was for to record the revenue. Now, if the company is using a zero profit method, they're allowed to record the expense. So what they're going to do is debit will be construction expense, and credit will be your construction contract asset liability. But it only be for whatever our expense was. In this case, whatever the cost was, it cost 1 million. So you're going to do an entry for 1 million here. And then revenue, if our expenses are 1 million, our revenue is only be going to recognize for 1 million. So we're going to do is debit the contract asset / liability for 1 million, and credit will be your revenue from long-term contract. That will be 1 million. So that's what the difference is. Now this entry it's the same as what we did. This entry is exactly the same that we did under the percentage of completion method, under the completed contract method. They all are same. In this case, it was a contract asset / liability, and we have an accounts payable, and it was 19066 1916000. So that's the entry we had to do. So in this, and when we did the second entry was for our accounts receivable, and then we have a contract asset / liability, and that one was for your 2.4 million. So let's do that. 2.4 million. And going forward, what we have to do is then we collected the cash. We collected 1,750,000 debit cash, credit my accounts receivable. That will be your 1,750,123,1,750,123. So that's the entry. Now, when you're recording the revenue and expense entry, you are going to debit the construction expense, and credit will be your contract asset / liability, and that will be for the expense that the material that we bought. Those are our expenses that we can record for the current year, 1916. So whatever our expenses are, we are allowed to record the revenue for the same amount. Then you're going to do contract assets / liability. Then the credit will be your revenue from long-term contract, and that will be the same amount as your expenses were. When you get to your last one, what you're going to do is you're going to record your same thing. We have a contract assets and liability. Contract assets / liability, I believe it was 1134 because it was 405. That's what we started. That's the total cost. We already recorded 1 million of the cost, and then we also recorded another 1,916,000. Whatever we're left with, we have to record it, and credit will be your accounts payable. My second entry will be for the billing, and that will be your contract assets / liability. The billing is 1.2 million. We're going to record that. Then what we're going to do is we're going to collect. So when we collect it, debit the cash, credit your accounts receivable, and what we're going to collect is your 2 million. This is your 2 million. And then the third entry is now we're recording the revenue and the expenses. So whatever the expenses are, we're going to record it. Whatever it cost us, we're allowed to expense it. And then we're going to do contract asset / liability, and it will be for the 1134, and then you're going to record the revenue here. So when you're going to record the revenue, in this case now you're going to be recording the full revenue at this point. So that will be your full revenue that'll be recorded. So in this case, the revenue will be 1584. Now we're allowed to record the full revenue here because now we have to record the profit. So you have a contract asset/liability of 1584, and then you're going to record your revenue from long-term contracts. Then how did we needed to record the total revenue that, so that in other words what we had to do is we have whatever leftover revenue that needs to be recorded, because now at this point we wanted to show a profit. So that's what's going to happen. We have to show the profit at this point. Now that is it for, there's 3 methods of it. There's percentage of completed contract method, and zero profit method. The entries are similar, but some we have more entries and some we have a less entries. That's the only difference. Other than that, it's the same theory. This is to be used for a long-term contract methods. So that's the second part of the chapter 6 is long-term contract. I'm done. We finished the chapter number 6. So if you have any question, please like the videos. If you have any comments, make the comments underneath the videos. If you have any other questions, you can reach out to me through an email or talk to me in the class. Thank you so much for listening to me. Take care and bye for now.